All right, welcome back, everybody. Today is Friday, May 2nd, 2025. This is You've Got Options for Income Navigator. Today, we're going to talk about a strategy slightly different from what we normally talk about in our community. This is a poor man's covered put. Before we get started, quick disclaimer, today's presentation is strictly for educational and or entertainment purposes only. This is not a financial advice. We are not your broker. We're not soliciting, buying, or selling any securities. If you are looking for advice, you need to speak to your financial advisor or your financial professional. With that being said, let's get started. So, in the recent months, trades such as covered call has become very popular amongst many different communities. Now, we all know that, with a covered call, you buy stock and you sell a covered call against it. Sometimes, right, buying stocks, you only have so much capital that you can allocate to buying shares of any individual company. So you go and you replace the long stock with an in the money call, right? You get long exposure through an in the money call, and then you sell a at the money or in the money or out of the money call against your long call position to generate some near term or short term income. Now, covered put is the same exact concept except the other way, right? It's not a bullish trade by any means. It is a bearish trade, the opposite of a covered call or a poor man's covered call, if you will. A poor man's covered put is an option strategy that replicates a payoff of a traditional covered put, but with lower capital requirements and defined risk. And this is very important. Defined risk is, I think, the key and probably the most important part of this trade. Rather than shorting the stock, which is capital intensive and comes with unlimited upside, right? I want to highlight that unlimited upside. If you trade individual stocks that have risk of getting bought out or some kind of event, earnings, FDA announcements could push the stock much, much higher, right? The upside is unlimited. And if you're short that stock, obviously your risk to the upside is unlimited as well. This trade is done by buying a long-term put, and often it is a leap, something that's 365 plus days out. And then you sell a near-term put to generate short-term income. Now, I don't want to confuse you, but I just want you to think about, right, the covered call versus covered put. It's the exact same thing. You buy an asset, long-term asset, right? You pay for it. It's a debit. And then you generate short-term income by selling short-term options against it. This approach simulates a covered put risk reward profile, but limits maximum loss to your net debit, right? This is the cost of your long put minus the premium received from the sale of the short put. This strategy is built into two legs. Step number one, you buy a long term put. Now, strike selection, expiration, these are all great tools for risk management. I don't think there's any one number that works and everything else doesn't. I think anything works. Whatever works for you, that's what works. But generally, right, as a guideline, we'll use, as far as strikes go, you select an in the money strike to buy, and it has to be a long term put. Does it have to be a leap? It doesn't, right? You can go 90 days out, you can go 60 days out. It all depends really on your near term price outlook. And when we go through the example of a SPY trade that I did today, maybe we'll clear things up a little bit as far as directional exposure goes. So we select an in the money strike for the long leg. As a guideline, we could use deltas somewhere between 60 and 80. Keep in mind that puts always have negative delta, so it's -6 or minus 0.6 to minus 0.8 or minus 60 to minus 80, right? So they are in the money. As far as expiration goes, you can choose anywhere between 6 to 12 months, but you can do it on the shorter time frame as well. The purpose. Uh, the long leg of this strategy acts as a proxy for a short stock position, providing downside exposure, right? If we buy a 60 delta put, that means for every $1 that the underlying is going to go down, we are expected to make about $60. And at the same time, if we're long a 60 delta put and the underlying goes up $1, we would expect to lose about $60 for the long leg of this trade. So therefore, this is a short stock replacement, which gives you downside exposure. The next step is we're going to sell a near-term put. Strike selection. Typically, we'll go out of the money or at the money. We don't want to sell another put in the money. At the money works fine. Out of the money works just as well. And, if we wanted to put some delta numbers around it, at the money would be a delta 50, out of the money could be delta 30, delta 40. And again, it all depends on your near term price outlook. Now, let's think about these things in terms of delta. If we are long a 60 delta put, right, we're minus 60 on our net delta exposure. And if we short a 50 delta put or at the money put, right, that's plus 50. So we get minus 60 delta from the long leg, plus 50 delta from the short leg. Our net exposure is minus 10, right? This would be equivalent of being short 10 shares of whatever the underlying we're using. Same thing goes, if you're more bearish, right, you want to get a little bit more of a negative delta exposure, right, then maybe you buy an 80 delta put and sell a 50 delta put that is at the money. This will give you a net negative 30 delta exposure, right? Hopefully that makes sense. As far as expiration goes, we definitely want to be shorter duration on the short leg than we are on the long leg, right? We're holding a long put longer term and we're selling near term options to generate short term income. I put down anywhere between 2 to 8 weeks. Could it be more than that? Sure, right? Anything that works for you works. You can get long a 90 DTE put and sell a 30 DTE put. Or you can get long a 90 DTE put and sell a 60 DTE put, right? There really is no one is right, everything else is wrong approach here. You have to play around with it. You have to model the trade. You have to look at the risk graph, understand where the risk is, how much the risk is, understand where the reward is, and how much you could potentially make in whatever the time frame is, and then whatever works best for you in your situation is the trade that is the best. The purpose of selling a near-term put is to generate income by collecting the extrinsic value of the short put. This setup allows you to repeat the income leg, right? Because if we're selling short-term puts, maybe 2 to 8 weeks out, but our long puts have 6 to 12 months out. Once the first tranche of these short puts expires, maybe it expires out of the money, maybe it's going into expiration and it is in the money, and we'll talk about potentially rolling out. You can, right, as long as the value of the short leg has decreased and it is worth less than what you originally sold it for, you can possibly roll out and collect additional income, and you can do it multiple times up until your long leg is coming due to expiration. You can do it across multiple cycles while maintaining your long position as an anchor. Now, this is also very important. When do we want to use it? I want to say this right away, that I do not think that applying this strategy in a campaign style is the best. Why? Well, unless you find an underlying that is in a very strong downtrend, and then you potentially initiate the trade when the underlying is making a lower high and you're looking for another push lower, then you could possibly hold this position for as long as the underlying remains in a pretty solid downtrend. Now, most of the time, right, if you look at the chart of SPY, sure, there are times when market goes down, right, and then market goes back up. Over time, right, I believe the market is going to rise. So doing something like a covered put or poor man's covered put on SPY in a campaign style over the next 2 years is probably not the best idea, because I think market is going to be higher than where it is today over the next couple of years. So you definitely want to have a bearish outlook, at least near term, and you will make a profit if the underlying stock declines. Even though you are short near term puts that may be at the money, and if the underlying declines, yes, your short put is going to go in the money. But remember, you have more delta, you have more directional exposure on your long leg, which is where you're going to make the money from, or this is where the profit is. You also want to use this in a neutral to sideways market. You collect the premium as the short put expires worthless. This strategy is not suited for strong bullish environments. And you don't need to be a market technician to look at the chart and kind of get an idea, how far we are away from the mean. And this is what I use. I look at, 21 EMA as the mean, right? Because I feel like the price will always revert back to the mean, right? Even in the downtrend, the price is always going to revert back to the mean, right? So if you look at the chart and let's say you're using ATR bands, right? If we are in a downtrend, but the price of the underlying asset is 3 ATRs away from the mean, this is probably not a good spot to initiate a new trade. Maybe if we are in a pretty solid downtrend and we just reverted back to the mean, right? So we're testing that 21 EMA and we think the downtrend is going to continue, then potentially setting up a new trade or rolling your existing short put to capture more extrinsic value at that point in time would probably make the most sense. Now, if the trend is very strong to the upside, you look at the chart and the trend is to the upside and it's pretty strong, it's pretty consistent. Every time we pull back, maybe we'll pull back to 21 EMA and then we bounce. And then we continue to trend higher. At some point, we'll pull back to 21 EMA and then we bounce. This is not the kind of environment where you want to utilize this trade. So you first and foremost want to understand, are we in an uptrend? Are we in a downtrend? What is your near-term directional outlook? And if you think that near-term we're neutral to slightly bearish, then I think that is the best time to use this trade. Let's look at an example, right? We picked an XYZ stock, no particular stock. Let's assume the stock is trading at around $90 per share. We buy a long put. In this example, we'll use a leap, $95 strike. As you can see, with the stock trading at 90, a 95 put is already $5 in the money, which means it is worth at least $5 plus whatever time value or extrinsic value. So if we're buying this put that is expiring in 12 months for $9, a 95 put with stock trading at 90, $9 represents 5 of this 9 is intrinsic value, $4 of this $9 is the time value or extrinsic value. So we're paying $9 to get long a 95 put 12 months out. Next step, we sell a near-term put. We'll sell an 85 put that expires in 30 days for $2 or $200 total premium being collected. Now we can tell that 85 put with stock trading at 90, this put is out of the money. It has no intrinsic value, and $2 that we're collecting is pure time value. This is extrinsic value. Now, the premium we're collecting goes to offset the cost of this long-term put. We're paying $900 for the long put. We're collecting $200 for the short put. Our total outlay is $700. There are multiple outcomes, right? Let's talk about what if the stock stays above 85, right? It does not go down. Or maybe it goes somewhere between 90 and 85, right? We initiated the trade, stock's at 90, we bought the 95 put, we sold the 85 put against it, and the stock is above 85, which means the 85 put that we sold for $2 is now worthless. We get to keep the $200. Now our effective cost base is now $700, right? So initially we put up 900, we collected 200. When the short-term put expires, our risk now in this trade is just $700. And the long put will retain its value. We could continue to sell new short puts against it, essentially reducing our cost basis down from 700. Maybe we'll sell another put, collect another $200. Now we'll reduce our cost base down to $500. Scenario number two, what if the stock does decline? Remember, we initiate such trade expecting lower prices near term. Okay. And this is where some people start to freak out. And, we could talk about this a little bit so that we, understand exactly what is happening. If the stock falls below 85, some will say, oh my God, I'm short 85 put. I'm going to get, long stock, and they panic out of the trade. If the short put gets assigned, right? If the short put gets assigned before expiration, this is probably because this short 85 put has no extrinsic value left. What that also means is that your long put has no extrinsic value left. So if you get long stock at 85, you can probably just flatten out this position and close out your long put to make a profit. The only really risk is if you get long shares at 85, and that's going into the weekend, and then something happens over the weekend, and the following day, the market opens, much lower or much higher. So there may be a gap, but I don't think the risk of getting assigned early is that great. You could also think about it in terms of what's going to happen to your net exposure in the position where you're long 100 shares at 85 and you're long a put at 95. Right? Your long stock at 85 gives you plus 100 delta. That's your exposure for the long shares, right? So you're plus 100 on the long stock. Now your long 95 put is probably minus, 90 delta, right? So plus 100 minus 90, your net combined total delta for position, if you get assigned early, is going to be about plus 10. It will be equivalent to being long 10 shares of stock. So yes, if you get assigned early, right? Let's say on a Friday, you get a notification that you have been assigned. You didn't do anything. You went into the weekend long 100 shares and long one long-term put. Your net exposure may be plus 10 delta. And the risk is if the stock tanks over the weekend, so yes, you will potentially lose about $10 for every $1 that the underlying goes down. But then eventually your long put, right, as the underlying goes down, that negative 90 delta on the long put will become negative 100 delta. And that negative 100 delta will offset your positive 100 delta of the long stock position. Right? So the risk is not as great. I don't think anyone needs to panic if you get assigned early. We can look at a risk graph on Option Explorer and try to understand what does long 100 shares of stock with a long one in the money put looks like. And then you could maybe get a better visual and understanding of where the risk is and how much of a risk you're taking. Let's talk about the profit and risk. This is it's kind of hard to calculate exactly what the max profit is because there are multiple moving parts, right? The 95 long put also has extrinsic value. So depending on what the market is doing, how fast we're moving, if we are, how much decay we're seeing on both the long and the short, and also volatility comes into play here, right? Because we're short volatility on the front month or on the short put, we're short volatility, but we're long volatility on the long leg or the long put. So if volatility falls all across all contracts, right, it's going to be a net benefit for the short leg, but it's going to play against us on the long leg, right? So we'll look at the risk graph as well, and we'll see how falling volatility will affect net position. But this is some guidelines here. If you want to try to figure out what your max profit is, you take your in the money spread width minus the debit plus remaining extrinsic value, right? And this is the unknown, the remaining extrinsic value. We could try to guess what the remaining extrinsic value may be, but again, it's a moving target. It's kind of hard to guess. I wouldn't want to, tell you, use this formula to try to figure out what your P&L is. I always say that you need to use whatever tools you have at your disposal. Like you want to use Thinkorswim, for example. They have Analyze tab, which is very, very useful, right? You can replicate trades that you're taking and understand and see the risk graph. You can I use Option Explorer, for example, where, you buy a long-term put, you sell a short-term put expires worthless, you sell another put, maybe you do it one more time. Next thing you know, 2 or 3 adjustments later, right? What's your running P&L? Are you up? Are you down? Where is the risk, right? How far can the stock fall or how far can the stock rise before you start to really, feel the pain? So and if you're going to try to plug in some numbers and try to understand what you're running P&L based on some formula, right? It's going to be a very difficult task for you to understand really where your risk is and how much you're risking. So using some sort of visual tool, I think is an absolute must. So in the above example, right, we have a $10 width, right? 95 put that's in the money, 85 put that's out of the money. That's $10 difference minus the debit, which is $7 or $700. Remember, that was our risk, which is about $300 plus any remaining long put value. Again, we don't know what the remaining long put value is. It will be different at different points in time. Price, time, and volatility will affect remaining long put value. So that's why it's a moving target, kind of hard to guess. One thing we know for sure, and this is probably more important than anything else. One thing we know for sure is that our max loss is the net debit paid. Cannot lose any more than what you have to put up when you take the trade. If you paid $900 for the in the money 95 put and you sold an out of the money put for $200, your net cost is $700. That is the most this trade could lose. Whereas, if you do a regular covered put where you're short stock and you're selling a put against it, well, your max loss, well, you don't know. What if the stock goes up 300 points, right? What if it goes up 500 points? We don't know what the max potential, the max potential loss for a regular covered put is unlimited because the stock could, rise into infinity. So this is a great and the most important part is that you have defined risk. You know exactly what's on the line. You don't necessarily have to risk the full $700 in this trade example, right? Maybe you'll implement some sort of a stop loss or mental stop or price stop or time stop, right? And we'll talk about that as well. So I kind of just went over this, but let's just go over this one more time. We're just comparing here traditional covered put versus a poor man's covered put. So the structure of a traditional covered put is we're short stock and we're short a put, whereas here we're long and in the money put and we're short a near term put against it. Capital requirement, this is a big one. Traditional covered put, where you have to short stock, will tie up quite a bit of your margin. Yes, if you utilize portfolio margin and whatnot, it could be much lower. But if you do it in the cash account, you will need to put up uh, a big chunk of capital. And also, if you short stock, you also will be responsible for any dividends. You also will have to pay borrow fees. So it could be, quite expensive to hold short stock for extended periods of time. Whereas here, your capital requirement is fairly low. All you have to put up is whatever your net debit for the trade is. Margin is very high due to naked short stock, whereas with a poor man's covered put, it's much lower. And this is another interesting point here is that when you're short stock and short a put, your near term outlook is definitely more bearish than if you were to do a poor man's covered put, where you're bearish to slightly neutral. And you can think about it in terms of delta to understand why traditional covered put is more bearish, right? If we're short stock, let's think about the delta. We're minus 100 delta. And if we're short at the money put, that's plus 50. So our net delta for traditional covered put is about minus 50. Whereas if we do a poor man's covered put and we're long a, let's say, 60 delta put, and then we're short a 50 delta put, our net delta is only minus 10. So here will be minus 50 delta, and with a poor man's covered put, we're only short about 10 delta. So this poor man's covered put is definitely less bearish, maybe even slightly neutral. And traditional covered put is definitely a lot more bearish because it has a lot more directional exposure. How do we control the risk? We can predefine max loss. Just because we had to put up, let's say in this example, $700 to put this trade on doesn't mean that we're going to risk the entire $700. Even though I don't think it's a terrible idea if you wanted to say, you know what, I'm not going to use a stop loss. If I'm willing to risk, let's say, $2,000 for any given trade, right? That's my max allowable loss. $2,000. And this $2,000 may represent some percent of your overall net lick of your account, right? So I'm just using this as an example. So let's say you said $2,000 is my max allowable loss for any trade. I don't want to use any stop loss. So you take $2,000, you divide it by 700 because that's what we have to put up. We get 2.85, right? So we can't do 2.85 contracts. So you choose either do 2 or you do 3. If you do 3 contracts times 700, right? You have to put up $2,100. That is the most you can lose. You don't use a stop loss, right? You put everything on the line at once. And then hopefully after several cycles, you're collecting a premium, you let the option expire, or maybe it decays, loses 50% of its value. You roll it out, collect more premium. All the premiums you're collecting will go to reduce your cost, which is, if you did 3 contracts and you put up $2,100, maybe in the next round, you collect another $200 per contract, and you have 3 of those. So you reduce your cost basis by about $600. Now your cost basis goes from $2,100 to $1,500, right? And then a couple of rounds later, maybe you get to reduce your cost basis to nothing, which means you own those long-term puts at no cost. Or you can say, all right, I have to put up $700 for this trade. I think the market's going to pull back. I don't think we're going to crash, but I think we're definitely going to, maybe just drift sideways to lower. I put up $700, but if at any given time I'm down maybe $300, 350, whatever that number that works with you, right? That is your sign to get out of the trade. Up, down, or sideways. If at any given time, if I'm down $350 maybe, or whatever that number is, it's time to get out. It's not a good time to start to look to make adjustments and rolling in here and there. If your stop, if you're not willing to lose more than $350 for a trade, and it costs you $700 to get in, if your net running P&L at any given time is minus 350, it's time to pull the plug. We can also roll the short put, right? As expiration nears, we can roll out to a new cycle to maintain the short-term cash flow, right? Maybe we sold the 85 put in the example that we're using. Maybe we sold the 85 put for $200, and then maybe 2 weeks later, this short put loses half of its value, and this short put is only worth $100. You say, okay, you know what? Market went down just a little bit. I think it has some more room to the downside. And then you decide to buy to close that put for $100 and then sell another put for maybe $200, keeping 100 of the original $200 credit, right? So now your cost basis is not 700, it's 800, right? Because you bought the original short put for $100, right? So you can keep rolling from expiration to expiration. It doesn't mean that if you sold a put, right, the 85 put, if you sold it for $200, you don't have to hold it until expiration, right? If it lost some value and you want to roll it out, that's fine too. As long as you keep bringing in credits, you effectively will be reducing your cost basis. You could also make adjustments. If the long put loses too much value, you consider closing the entire position, or you can refresh the long. I don't really love the idea of refreshing anything. You bought the long-term asset, you're selling short-term puts against it, right? If at any given time the trade is not working, and it's not working, why? Because the underlying is moving against you. Okay, what does that tell you? That tells you that your original idea that the market is in the downtrend is wrong, right? You have to recognize when you're wrong. Are you wrong? So at this point, you have to make a decision. You can try to hold on until you will eventually be right, or you can get out of the way because you're wrong and reconsider the entire trade, right? You need to decide, do you want to be right or do you want to make money? You could also monitor decay. Remember, time decay or theta affects both longs and shorts, and you have to manage your risk accordingly. We know that short-term options decay much faster than longer-term options. So decay or theta is always going to be on our side, even though once when we look at the risk graph, I'll try to highlight this for you guys, that if the price runs out from underneath the profit tent, there is a point where theta is going to go against us. That's because the short put has already probably lost most, if not all, of its value, and now we are exposed on the long leg, and that long leg has negative theta, so theta could potentially turn against us. But I think that if we use proper risk management and we have some kind of either stops due to price, if the price is moving against us, got to get out. If the price is moving against us and too much time has already passed, it's time to get out. All right, so we don't want to hold on. We don't want to hold on to a losing trade for too long and then get hit with negative theta. Some takeaways. A poor man's covered put is a capital efficient alternative to a traditional covered put. It offers defined risk. Again, defined risk is key here. You know exactly what's on the line. It could be repeated opportunity to generate some short-term income, gives you flexibility for bearish to sideways markets. And I'll try to show you how you can turn a neutral to slightly bearish position to a completely neutral position by just moving the short put. So you definitely have a lot more you have a lot more opportunity to make adjustments and control your net directional exposure. It is best used by traders who want downside exposure but prefer to avoid complexities and risks of shorting stocks. Right? Some people have never shorted a stock in their life. This, isn't one of those things where, hey, let me, short a stock, see how that works out. So if you wanted to get some downside exposure, you've never shorted a stock, I think replacing short stock with an in the money put is a great way to not only define your risk, but also control your potential upside risks as well. One tip I have for you guys is that, and this is probably one of the most overlooked aspects of risk management is, I always say that the important parts of risk management are underlying selection, strike selection, expiration selection. You can select by implied volatilities. If you choose any wrong, if you choose a wrong vehicle because you ignored, what underlying you're trading, how much liquidity it has, you could potentially make a mistake that's going to cost you a lot of money. And what I mean by that, if you choose a stock that you think is going to go down, you completely ignore the fact that it's in a very strong uptrend with a potential risk for some FDA announcements and whatnot, right? You're setting yourself up for not a good experience. I think one of the biggest things is liquidity, right? If you're going to buy a long-term put and the put is in the money, just remember, if you go to the market and you try to buy an in the money put, right, you're essentially asking the other side or the market makers to sell that put to you. Why would a market maker want to sell you an in the money put? I mean, obviously they want to do it because that's their job, but they also have to go out and figure out a way to hedge off their risk. Right? So they would not be willing to play on your terms. Let's just say that. So if you go to the market and you want to buy an in the money put, well, odds are, right, you're going to find that the bid ask spreads are much wider. It doesn't have to be much wider, but it's definitely going to be wider than if you compare a bid ask spread of options that are at the money, right? Because that's where all the action is. At the money, out of the money, right? This is where everybody wants to be. Nobody wants to trade in the money anything. So the deeper in the money you go, the wider bid ask spreads are going to be, which could potentially cost you, right, due to slippage. And then imagine if you are in a rush to get out of a trade in the money leg of your option trade, and the bid ask spread is super wide. Now maybe if you're in a rush, you don't have the luxury of sitting around and waiting for the market maker to meet you in the middle, right? And if the spread is too wide, you could potentially get hurt. So looking for underlyings that have super good liquidity. You also want to trade. You want to trade underlyings that have lots of different expirations and lots of different strikes, right? That gives you flexibility to, if you wanted to roll, for example, SPY, you want to roll 1 point, you roll 1 point. But if you go to something that has $5 strikes, right, you could, if you look at the delta of those, strikes, you can look at, one put that you're looking to sell is a delta 30. The next available strike is a delta 15. And that 15 delta, the 15 delta is going to make a big difference in your net position directional exposure. So you definitely want to stick with underlyings that are very liquid, have good options, have good bid ask spreads, and also have lots of expiration cycles and have lots of strikes available. So now we're going to go and switch over to the Option Net Explorer, and I'll talk about um, the trade that I did earlier today. This was done in SPY, and SPY right now is kind of moving higher a little bit, which is, not ideal. But again, we didn't do this trade for a day trade, or I think that, holding this for maybe a week or two, right? The front month only has 14 days. So this is a trade that's going to expire on May 16th. And my strike is at 35 delta. So I didn't go at the money. I went a little bit out of the money, right? I gave this trade a little more directional exposure, a little more negative delta. Because if I would have went at the money, right? If I'm long August 29, 590 put, right? With SPY trading at 567, the 590 is in the money already. And then to generate short-term income, I am short a 560, which is a 35 delta. So my long put is 65 delta. My short put is 35 delta. Net, I'm about negative 30 delta. I hope you guys are, thinking in terms of, the deltas, not necessarily how much did I pay for this and how much did I collect for that. Sure, that, it's important to understand what you paid, what you collected, and how much you can make. But understanding, if the underlying goes up or down 10 points, which is, about 100 points on SPX, what is this trade going to do? Right? If SPY goes up $10 tomorrow, right? I should expect to lose about $280 here. Well, let's see. From 567 to 577, right? I'll be down about $369, right? Because my delta is going to change over price as well, and that's a function of gamma. And then if the underlying goes down $10 from 567 to 557, right? I would expect to make about $300. But because my delta will change over price to the downside as well, right? So I'll make a little bit more. I'll make a little bit less, sorry. And then you can also factor in the fact that we're positive theta. So, if this happens over the next, couple of days, then yes, at 557, I will hit that $300 target. Right? So the way I set up this trade, and I posted this trade on Discord, I haven't assigned the trade ID, but the trade ID here is 3140. And I wrote that I'm buying a longer term put. This is August 29th with, I believe it's 90 days. Hang on, let me check. So August 29 is actually, come on. August 29th is 119 days. And then I am short May 16th, which is 14 days. My goal here is to hold on to this trade for, I can't hold this for more than 2 weeks without having the short put expire, right? So in the next 2 weeks, we're going to know if this trade makes money or it doesn't. If the underlying goes down to, let's say, 550, yes, my 560 is going to be $10 in the money, right? But remember, I'm going to make more with my long put than I will lose with my short put. Why? Because my long put is already 65 delta, which means I'm going to make $65 for every $1 move in the price of SPY to the downside. And I'm going to lose about $35 for every $1 move in the price of SPY to the downside. Net, net, I would expect to make money. So if you're sitting around and you're thinking about, well, the underlying went down, I'm getting killed on my short put, but you're not taking into account that your long put is making you money. That's why I said earlier today, it is very important that you keep a spreadsheet and you keep track of prices. You know, what did you pay for your long put? What did you collect for your short put? If you did multiple tranches of the short put, right? At some point in the future, you may sit around on the short put that, yes, it may be down money, but if you had already recycled several short puts prior to that, your trade is doing exceptionally well. But in your broker's platform, it's not going to show you that you're doing exceptionally well because it's not keeping track of trades that you have already realized profit in. So, as far as what am I going to make here? Well, it's kind of hard to tell what we're going to make on the downside, right? Because there is some potential extrinsic value of the long put, and we don't know what it's going to be, 12 days from now. We can project something, and I'll tell you one thing. If I take this trade now, and then 12 days from now, let's say both long and short are now in the money, right? Let's say we're at 545 on SPY, and this trade is showing me a $600 gain. Great, right? My short put is going to be down money, but my long put is going to be it's going to be more profitable, and the profits from the long leg are definitely going to cover the losses from the short leg. I may just take the whole thing off. Again, why? Why wouldn't I run it as a campaign? Because if we go from 566 on SPY down to 545, right? We're down about $20 on SPY. We're down 200 points on the SPX. Now I need to go look at the chart and revisit. Where are we? 545. Okay, we're testing. Maybe we're testing, the rising 21 EMA. Did something change? What's happening? Do I still want to maintain, right, short exposure to the markets? I mean, at 545, you can see my delta is actually positive 15. So the question is, do I want plus 15 delta in SPY? Does it align with my near-term price outlook? I don't know the answer. When we get to 545, I'm going to have to look and try to figure out, what's happening and if this, in fact, is what I want to continue to hold. It's not a terrible idea, but if the market's going to continue to sell off, you can see that I'm now sliding down on my T plus 0. Right? So do I want to continue to hold? If there's more downside here, but my delta had already flipped positive, maybe I need to make some changes, right? And what changes would I make? Well, I can possibly roll my short put. It's going to be in the money, so I'm going to actually pay a debit, right? And then I can go out maybe 2 more weeks and down a little. Right? And reset my directional exposure at that point. As far as stop goes, someone asked me to talk about a stop loss earlier today. I use a very simple method here. I don't try to use some formulas or look, what is realistic for this trade to make in the next couple of weeks? Am I going to pin 560 and make 800 whatever plus dollars? Probably not, right? But in the next couple of weeks, I think it's not unrealistic to think that if the price of the underlying asset goes below 560 all the way down to about 540, right? This 20-point window, I think I could make between $400 and $600 in this trade. How much am I willing to risk? Am I going to risk $2,400 trying to make $400? No. The answer is no, right? So would I be willing to risk $600 trying to make $400 to $600? Okay, that's not a terrible risk reward, right? Right? Maybe I'll risk 600 trying to make whatever I could make inside the tent. Where's my minus 600 line? It's right at 585. Right? So if the underlying goes up to 585, well, what's happening here? Clearly, my directional outlook is wrong, right? I am not trying to be right. I'm not going to hold this until I will eventually maybe be right at some point in the future. If the underlying is moving away from the tent, because this is where I make the money and this is where I lose the money. So if the underlying is moving away from where I make the money, sure, it may be temporarily, but guess what? The price is clearly telling you that your directional outlook is wrong. So maybe it's time to get out at 585, right? There may be a loss of about $600, and I need to rethink. Why did I take this trade? I need to go back, maybe look at the charts. What told me that it's a good idea to take this trade with a bearish outlook when the price was trading at 567? Right? I'm not going to try to blame anybody or anything. I need to look within me. Why did I take this trade? Because the price moved from 567 to 585. Clearly, I was wrong on the direction, and it is important to understand when you're wrong, understand it soon enough to limit your losses. So maybe you're wrong once or twice or 3 times out of 10 times, and there will be some losses. But if you're right more than you're wrong, right? If you're going to make between $400 and $600 7 times, and then you're going to lose $600 3 times, is it a profitable net business? So maybe we'll average $500, right? Between 400 and 600, it's $500 7 times. That's plus $3,500. So if we're the winning trades will total $3,500 profit. If I'm wrong and I get out down $600 and I'm wrong 3 times, that's minus $1,800. So minus $1,800 from $3,500, I would expect to make net about $1,700 in 10 trades. Right, so there's some positive expectancy here, but again, this is not just pure probability. You also have to be able to look at a chart and try to understand, like, are we getting too far away from some underlying moving averages? Are we overbought? Are we oversold? Right? Are we running into resistance? Are we running into support? So there's definitely some human element that needs to be present here, and you need to apply discretion. And more importantly, understand when you're wrong. Don't fight with the trade. Don't look for news headlines why you're going to be right. It's just easier to get out of the way. Clearly, you're wrong, and try to learn and not to make the same mistake again. Right. So that's why I chose 585 as my stop. It's not a magic number. You just say to yourself, look, if I'm going to make somewhere maybe maybe $600. Maybe I'll make $500, maybe, $350. I'm not going to risk, $2,500 on this trade. So if I'm down $600 and the price is clearly moving away from me or from the profit tent, right? It's time to get out. So that's as far as my stop loss goes, right? In the example that we looked at on the document that I shared, right? If we paid $900 for the long, we collected $200 from the short. We put up $700 to put the trade on. Maybe you say, you know what? I'm just gonna not use a stop loss and risk the whole thing. But I just don't think the risk reward, and I don't know what kind of win rate you need in order to make this a successful trade long term. If you're going to risk, in this example, $2,800 to potentially make maybe $400 or $600. One more thing I want to show you before we end is the volatility effect. I know this shows us that we're positive Vega, which, yes, we're long more Vega with the long contract than we're short with the front month that expires in 14 days. That gives us a net long Vega exposure. But in case, right, the reason, and I say this because, if we're trying to figure out what's my max potential reward, even at expiration, it's hard to tell. I want you to pay attention to how this risk graph at expiration is going to change. And it's going to change. It's going to either rise or it's going to sink. And this is all with implied volatility changes. If, let's say, the market goes down, right? It goes down and it goes down slowly. We have, right, we're short volatility on the front month, which is working for us, but we're also long volatility on the back month, right, which is going to work against us. Yes, the volatility should fall less on the back month, but it doesn't always happen that way. So if we just take volatility down a couple of points, right, the peak of my risk graph at expiration is now barely touching $400, right? And then if we go forward a couple of, maybe 6 days into the future, if the market just goes down, but goes down very slow and volatility gets hit on both front and the back month, the whole thing is going to sink. And you can see that my profitability goes drastically lower. On the flip side, if volatility is going to rise, this is definitely going to give us, or it should give us, a boost. The only thing I don't always agree with these price models, or these with things like Option Explorer, right? These risk graphs, is that if I take volatility up 4 points, well, look at the peak of my tent here is now 800. It's now almost 1300, right? So I have a lot more potential. My profit tent got much wider and bigger. But it doesn't always work that way. Why? Because we know when volatility spikes hard, it's the front month where we're short volatility that gets the most juice, right? So yes, the long leg is going to help, but I think net volatility is not going to be in our favor because we're short volatility with less time until expiration. And as we know, just like right now, if you look at the VIX Central, you will see that near-term volatility is still higher than longer-term volatility, because when the market gets crazy, when things start to really, rock and roll, it's the front month, it's the 14 DT, that's 21, it's the 7, it's the 0 DTs, all the short term. This is where the market is going to reach for protection. They're going to bid up these puts, which is going to jack up the value of these puts a lot more than the contracts that we're long. And I think net effect of sharp rise in implied volatility is actually going to play against us here. I know that this is slightly off topic here, but I don't want anybody to, completely fall in love with the idea. Ooh, look at this trade; it's bearish, it's positive Vega. I think Vega could be very tricky right here. Let's take a question. Is this a trade you might put on in SPY given its latest very significant run up, looking for a breather or a pullback? It's part of the deal, sure, right? The market's been up like 9 days in a row. The market is very hopeful that there's going to be a deal, and there's all sorts of indications that the deal may be coming. But where's the deal? Right? So is the market going to continue? I mean, they may have a deal in June. They may have a deal in July. I don't know when the deal is coming or if it is. So is the market going to continue to melt up in the anticipation of a deal? Maybe. But guess what? If we get to 585, I don't care if there's a deal, if there's no deal. I don't care what's going on. It's time to pull the trigger. And if the market says, you know what, we've moved up quite a bit, it's time to take a breather, maybe back and forth, Well, what's going to happen here? We have positive theta that's going to work in our favor. We are also short volatility near term, which is going to work in our favor. And God forbid if the market just pulls back a little bit down to maybe 560, which is just 1%. I mean, you remember when market was moving 2% a day? Yes, with the VIX right now at, I don't know where the VIX is, 22, maybe, right? I don't know. Is it 22? It is 22 divided by 16. The market is pricing in right now on a day-to-day basis, up or down about 1.3%, 1.4%. So if we move on Monday or Tuesday of next week, if we move just 1.5% to the downside, yes, this trade is going to show a pretty decent return on risk and a profit. And then, right, we'll look at where my delta is. We'll try to figure out how much more negative delta we need, if we need it, if we don't. If we get it down to five, I don't know, maybe we get down to 560 and I'm short 20 delta on SPY here, and the market looks like every dip is being bought and we don't no longer want to hold negative delta, there are ways to flip this delta, right? We can remove our short leg, and then maybe we'll go a few weeks out. And if we remove the short leg, now our delta is 65. If we wanted to completely neutralize our position, well, guess what I'm going to do? I'm going to go and I'm going to short a 65 delta put and turn this into something that looks like this. Right? My net delta is kind of flat. Yes, there's risk to the upside. There's also risk to the downside. But near term, I don't really have a lot of directional risk. Theta is in my favor. I'm also short volatility. So there's ways to turn this from a bearish to slightly neutral. If I wanted to make this a bullish trade, maybe I'll move, right? I don't want to say hate, but I don't like, right, moving my strikes deeper and deeper in the money. Remember, I said once you go in the money, the bid-ask spreads are not as tight. There's all sorts of problems that could potentially happen there. But at the same time, right, if I wanted to turn my bearish trade into a bullish trade, this is, by the way, exact same risk graph as an out-of-the-money call calendar or call diagonal would be. All right, so there's definitely ways. There's definitely tools that we have at our disposal to potentially control our risk by just moving parts of this trade around. So that's all I have for you guys. If you have any questions, they are more than welcome on Discord. I posted this trade. If you want to follow along, I highly, highly suggest you guys paper trade. If you've never done this, if you don't fully understand, maybe you need to rewatch this video several times. Maybe you need to ask some more questions and then try to figure out how you can use this. If this fits in your overall trading, maybe you need some near-term bearish exposure against your longer-term bullish positions and whatnot. It's just kind of like pieces of the puzzle that you are trying to put together, and this is just another piece. All right. With that said, guys, thank you for your time. As always, have a good weekend. Make sure you take care of the risk and the profits. Let them take care of themselves. You take care of yourselves as well. Have a good weekend. Until next time. Bye-bye, everybody.